Hello everyone, and thank you very much for joining. This is FXCM's 2022 Trading and Markets Outlook. We've titled it Pop Goes the Liquidity Bubble, and we'll explain why in a moment. My name is Russell Shaw. I'm a Senior Market Specialist at FXCM. I'm going to be co-presenting with my fellow Senior Market Specialist, Nicholas Tsabouris. I just want to bring Nick in just to do a sound check. Nick, you there?
Hello, Russell. Hello, traders. Glad to be here with you to discuss markets, and hope everything sounds and looks okay. If anyone has any issues, they can type that so we can check. But it looks like everything is fine, right?
Yeah, I think so. Let me just, if I can get you guys just to give me a Y or an N. Can you guys hear us and see the screen okay? Just if you just type in there Y, just to give us an idea that we're ready to get going here. Okay, terrific.
Okay, perfect. Thank you all for typing in.
All right, I'm going to just bring up some disclaimers. The first one is our high-risk investment warning. I'm going to just keep this on screen for a few moments. Then we'll do our commentaries disclaimer, and then we'll get into it.
Yes, please read through carefully.
All right, guys, let's just get the market commentaries disclaimer up. Obviously, this is a 2022 outlook, so it is, I think Nick and I have tried our best to put together something coherent and sensible and sensical, etc. Of course, we don't have a crystal ball, right, Nick?
Exactly, yeah. Obviously, we're trying to think of what is going to some things that are going to probably be in the market's minds this year, but obviously we don't have a crystal ball, as you said, and it's also a little bit based on what we know now. We can predict the future. So
100%, exactly right. So this is what's the current market themes, and they're important market themes. We think they're going to be around for quite some time. But of course, you guys know markets are extremely dynamic. And I think with this introduction, I'm going to kick off with our first slide, and then I'm going to bring Nick in here. But you can see that this is kind of the linchpin. This is where we start. Inflation is running rampant, and it's at levels that I think are concerning. Nick, what are your thoughts around this slide?
Yeah, so obviously I think that inflation is the main concern and the overarching theme in markets. High inflation in particular. The chart you show there is for the United States, where headline CPI inflation is at 7% year over year for December, which is the highest since 1982. Many of us here may not have even been born then. We're talking about Ronald Reagan, president of the United States, and Paul Volcker, head of the Fed. So inflation is obviously high, and of course we also have the PCE inflation, which is at 5.10% year over year again for December, which is also the Fed's preferred measure of inflation. But and that's been the main driver for the Fed, right?
Yeah, exactly. I just want to just going back to this slide here, inflation. So the beginning of the slide, you can see we're looking at the early 80s, and since then we've basically been in a situation where there's been let's call it disinflation. I mean, there's been some scares of deflation, but I think we can all agree that the inflation that we've seen over the last few years has been relatively benign, much to, I guess, the chagrin of the central banks. And this is what Nick and I are saying. This year it's different. This year we're starting off with a bang, isn't it, Nick?
Yeah, obviously, and we saw that the Fed has made a hawkish pivot recently. Would probably say from around November, right? Would you agree with that?
Yeah.
And they used to describe inflation as transitory. They dropped that, and now it looks like high inflation is what drives their actions. Because let's remind also our listeners here that inflation essentially has a dual mandate. One is price stability, and the other is maximum employment. Up until a few months back, they seem to focus more on employment, but now it's clear that their main driver is inflation.
Exactly right. Now, the reasons for inflation are up for debate, but I want to bring in our next slide here, Nick. I think this is going to tell a story in of itself, and this is the Fed balance sheet. Just your thoughts around that.
Yeah, obviously it has ballooned due to the extraordinary policies that the Federal Reserve, not only the Federal Reserve, but now we're talking about the Fed, enacted in the wake of the pandemic to combat the economic fallout, and in particular the quantitative easing program. And we see that it's nearly 9 trillion, right?
Yeah, so this is the point. So Nick's saying, look, we're right by this 9 trillion. This is, I hope you guys can see my mouse, but if we go to the 2020 area, you can see it skyrockets up here. This is where the pandemic hits. This is where the Fed comes in with their unlimited QE program, and you can see since then we've got a completely abnormal situation on our hands. A relatively flat balance sheet. In fact, it was coming down into 2020. All of a sudden, we get hit by the pandemic, and now we've got a flood of liquidity that has come into the market.
Exactly. Maybe do we want to comment on what the Fed is planning to do about those issues?
Yeah. All right. So yeah. Good. So let me bring in just to sort of give it a sort of an economics 101 feel to it. I'm just bringing in my Microsoft Paint here, and effectively what the Fed has done. Okay, what the Fed has done. We've got just a set of axes here, and these are just ordinary price and quantity axes. If you do a course in economics, this is kind of your first lesson, and we're talking about money here. So the price of money is interest, right? If we borrow money, we have to pay interest. If we lend money, we charge interest. Now, what this QE program has effectively done, okay, the demand for supply of money looks like this, is that because I'll just bring up the slide once more just to give you guys an idea. Okay, you've got this big jump up here, in assets. That's effectively the Fed buying securities, buying fixed term income securities. As they buy those securities, the money's getting pushed into the market. And if you take a look at your just basic supply and demand, we're pushing our money out that way. What's happening to the price of money is that it's coming down. Let me do it this way. It's coming down. Right now, what the Fed has done is they said, well, we're done with this program. We've kind of kept the financial markets going. It's time to normalize. They want to normalize the balance sheet. And that normalization, well, that I think is what Nick and I are going to be watching with intense interest, because it's going to be pushing the supply curve this way. It's kind of moving the liquidity out of the market. And that's for us. The 2020, that's why we've called it pop goes the liquidity bubble, because it's an experiment, isn't it, Nick? It's one big experiment.
Yeah, of course. Obviously, we've been down this road after the financial crisis because they enacted similar programs and then they had to unwind all this stuff and normalize monetary policy. But it also seems that this time around, it's a more accelerated process, let's say.
Yeah, and I think just sorry to cut you off there. Do you want me to bring in the next slide? The next slide is the US 10-year. Or do you want to carry on with the slide?
Sure, go ahead.
Okay, just to I think to tie in with what we're discussing here. So this is the 10-year. So Mick, I'm going to leave this one in your hands.
No, go ahead. You can go ahead. I mean, we've seen a big increase in U.S. Treasury yields, but yeah, go ahead.
Yeah. So what? Just going back to the supply demand. Remember what we're talking about here on the y-axis? We're talking about the price of money, interest. That's what we're talking about. We're talking about here quantity of money. Quantity of money is at the moment the market is expecting this to shift in. Market's always forward looking. What's happening to interest? And this is really, I think, a terrific chart to be looking at. In technical analysis, you know, we're always looking at patterns, and we have something called reversal patterns. We have something called continuation patterns. Oh yeah, we've got a reversal pattern. It's an inverted head and shoulders. We've got a this one's actually backwards. I beg you. This is the left shoulder, and so this LS should be there. This RS should be there. I beg your pardon. But the point is, we've got an inverted head and shoulders here. And that in effect is classified as reversal. So we've had this situation of very low interest rates for a fairly long time, and it doesn't look like that's the case anymore. Nick?
Yeah, it appears to be. It appears to be, and again, it's all about how markets react to inflation, how the Fed reacts to inflation, and to all those policies that had been enacted in the wake of the pandemic, and where we go now from there.
And what I've put into this chart here, we call this a measured move. Now, I don't want to misrepresent. I don't want to misinform. So just please listen very carefully. Measured moves are academic in nature. So the way that you would measure a move here, you'll take the low point from the head to the neckline, and then you would extend it outwards, and that kind of gives you an idea of a target. So there's a number of aspects here. First of all, this is on what we call a logarithmic scale. You can do measured moves on an arithmetic scale. We won't get into that now, but this is on a log scale. It's given us a target of 3% in terms of interest rates. Now, I don't know if we're heading to 3%. Nobody knows if we're heading towards 3%. But I think the idea here is that it is showing an appreciation picture in terms of yields. In fact, Nick, how many hikes are we looking at this year? What's the market expecting?
Yeah, so if I may take a step back and sort of like offer a recap before I answer that, a recap of what the Fed is actually doing.
Yeah, please do.
Just to offer a recap. So the Fed had slashed rates, they're near zero, 0.25% in order to help economic activity, and it had also enacted this QE where it buys bonds and essentially throws money into the market. So now they concluded their quantitative easing. They've said they will conclude it in early March. Right. And they expect to start increasing rates as well from the current near zero levels. That is, again, lift off is expected based on what the Fed has said to begin in March, and they expect to have multiple rate hikes within the year. Now, the Fed's projections, the last projections of the Fed for its own rate path sees 3 rate hikes within the current year. Again, with lift off probably in March. Now, markets are more aggressive than that, and they're currently pricing around up to 5 rate hikes of 25 BPS. So
25,
that would essentially
25 basis points. So 1.25% is what we're kind of looking at, which just incidentally it takes us to this 3% for the measured move. However, guys, just to reiterate, measured moves are academic nature. Sorry, let me go back to Nick. I just wanted to point that out. Nick, five moves, 25 basis points, realistic?
Well, obviously, if the Fed is already projecting 3, I wouldn't say that 5 is unrealistic, although we have the limited commentary on the 5 from the Fed, although we have heard some comments about 5 or 4 hikes. For me, but of course, you can go that far out, because what happens if they start hiking rates and inflation starts going down, right? They may need to adjust. But another interesting point is whether the moves are going to be of 25 basis points or of perhaps 50 at some point, either to start off with or at some point. And we've seen some high-profile investors calling for it. We've also seen some Fed officials this week not ruling it out. But as things are now, it would be probably hard to happen in March. But again, Fed officials that have talked about it say that they will need to see the data. We still have more than a month ahead us until the next monetary policy meeting by the Fed. But that for me will be one thing to watch out, if they will at some point have a bigger increment on the move on the rates. Okay.
Now, before I go to the next slide, I mean, we've been talking very much about the US. Do you have any thoughts, UK, Euro area?
Yes.
Yeah.
And before we go on, I just would like to remind to our listeners that they can also type their questions or thoughts, and whenever we have time, we will try to address at the end. Just one note there, they can type their questions or thoughts. Now, obviously, as you said, we talked a lot about the Fed. Of course, the Fed is not the only one on the monetary normalization game. I would say that the Bank of England beat here to the punch, delivering a rate hike in December, which surprised many investors, and it increased rates. And again, the main driver there was high inflation again. So now the latest figures on the US, on the UK headline inflation is 5.4% year over year for December. And that's a target that the Fed, that the BOE initially did not expect to reach until April. Now they see inflation peaking at 6% in April. So not only inflation is high, but it looks like it has more room to run, right?
Yeah, and of course, BOE is meeting today, isn't it? Later
exactly.
Today.
Yeah. So they're meeting today, so we'll be expecting to see what they're gonna do. They are forecasted to deliver another rate hike. It will be important to see also the statement and the forecast and the press conference, because we've had some communication issues with the BOE, because they surprised the markets by not hiking in November, and they surprised markets by hiking in December, right? I know you had some strong opinions.
I'll give our attendees some I'll tell an anecdote. So every Monday, Nick and I get together, we do a podcast, and we're going back towards the end of last year. I think it was November. There was speculation in the market in terms of the BOE raising rates. And I was convinced that they were going to raise rates. Of course, they didn't. So the next podcast, I came in sort of sheepishly and with egg on my face. And then come December, my opinion was, no, they'll need to wait till February, because February was when there's going to be the next press conference. Lo and behold, they raised from 0.1 to 0.25, so kind of a double whammy for me there.
Yeah, so we're gonna have to see how things will play out this time. And of course, it's not only US and UK that have high inflation. Inflation is high pretty much everywhere, but we also have Eurozone where we saw this week preliminary CPI inflation for January surging to 5.1%, with the final reading for December being at 5%. So inflation is an issue there, although the ECB does not seem to be that worried at this stage, and they're further back in their, let's say, monetary tightening cycle. They had announced in December that they would reduce their asset purchases. Essentially, what they would do is they will cut at the end of March their emergency pandemic program, and they will increase the normal, let's say, the normal asset purchase program, the APP, to 40 billion per month in the second quarter.
Yeah, and there is, of course, not only a BOE meeting today, right? There's the ECB meeting.
Exactly. Yeah. I don't know if you expect that much there, but I believe that obviously, again, the press conference by Ms. Lagarde is going to be in the spotlight, and we're going to have to see how she reacts to inflation and any press commentary around their thinking on rates, right?
Yeah, I think just speaking sort of personal opinion, it's last year it just seems the Fed was behind the curve in terms of the inflation, defining it as transitory right until the end of the year, beginning this year. And I just worry that the ECB may be following a similar path, but we'll just have to wait and see how that plays out.
Yeah, but in general, most major banks are in a tightening process, either by reducing quantitative easing or by starting to hike rates, or by ending quantitative easing. The ECB is a little bit on the less hawkish side, let's say. I don't know if we can call it obvious, but on the less hawkish side, perhaps, along with the Reserve Bank of Australia, which just this week concluded its quantitative easing, but pushed back against rate hikes. But I'd like a quick note that one bank that is on a different tune is the Central Bank of China, the People's Bank of China.
Oh, yeah, good point.
Yeah.
Good point. Yeah.
Yeah, which got some key rates this month, like the loan prime rate and the medium-term lending facility rate. Just a quick mention. I mean, it's not that the whole world is down this path, but most of the world probably is, right?
Yeah. So while most of the world is looking to tighten, the People's Bank is loosening, which is very interesting.
Exactly.
Just before we continue, just a pause here. Just as Nick said earlier, any questions, please go ahead and type those in. I don't see any questions, none have come through yet, but we've kept some time towards the end to answer any questions. And of course, I just want to, it was my mistake, I should have mentioned it right at the beginning. Please don't hesitate, go ahead and type those questions if you have. The next slide I'm going to bring in, I think, is a very interesting slide. I'll just, here we go. All right, so yeah. So this one I've titled Equity Rotation. This is, again, it's building off the theme of inflation. It's building off the theme of we're now in a rate hiking environment. Nick, I'm going to I'll start off. What's your thoughts on equity rotation?
Yeah, so obviously high inflation, high interest rates environment, high wages environment is obviously removing of monetary accommodation is not good for stocks, right? and we've seen Wall Street dropping in January. And obviously, this environment is, let's say, weighs more on the tech sector. And we saw, for instance, the NAS 100, the Nasdaq essentially, losing around 10% in January, whether the US 30, for instance, lost far less than that. So it's clear that the tech sector is hurting right now, at least in January, based on those themes. What are your thoughts here?
Yeah, so my line of thinking is very similar. So what Nick is saying is that it's the tech sector, the growth side of the market, that is very sensitive to interest rates. If you take a look at the charts, we won't show it here, but when rates were coming down, whilst markets were generally doing well, the sensitive market was the growth market, the Nasdaq, and that was outperforming. Now that we've entered into this, environment, which is very different to recent times. Now we're talking about a hiking environment. Well, the tech sector, the growth sector, that is the sensitive sector. Those are the guys that can potentially get hurt the most with those increasing rates, and it's mathematics. It's called the time value of money. When you apply the time value of money, portfolio managers may be saying, well, you know, which is the area of the market that is going to be the most exposed, and which is going to be the least exposed. So what we're suggesting is we may actually start finally seeing that equity rotation out of growth into the more value defined stocks. And what you're looking at here, this particular chart here, is the Nasdaq over the Dow Jones, the NAS 100 over the US 30. And you can see from the beginning of the year, end of last year, how the numerator, which is the Nasdaq, the numerator is the growth side, has really underperformed. And it's the value side, the more established, the more mature Dow Jones, which is showing outperformance. And again, very much a part of our theme, this liquidity that we've been seeing for years now, potentially being softened out of the market. Is that about right, Nick?
Yeah, but of course, we need to be cautious because sometimes markets also tend to overreacting certain things, because again, you point on the chart, we saw this theme, this rotation out of the tech sector also playing out a little bit last year at the beginning, but I think one would hardly say that the tech sector had a bad year, right?
Oh yeah. The tech sector certainly didn't have a bad year. In fact, Nick, you mentioned something to me a few days ago, expectations theory. You want to just mention that to our attendees?
Yeah, so essentially every market reaction has to do not so much perhaps with the facts oftentimes, but mostly about expectations. Like if we're expecting the Fed to hike, I don't know, 1 million times this year, and it ends up hiking 5, that's probably gonna disappoint those who wanted more rate hikes, right? So we're seeing now markets reacting to the expectation of a let's say high inflation and monetary tightening. But if the Fed, for instance, starts tightening and then does not adhere by market, but what the market want, let's say they're more conservative, that may play around differently for markets, right? I'm talking in general, just
absolutely. And I think that what Nick said there, I mean, is huge. Expectation theory is a huge variable in the market, and I think the difficult thing is, of course, expectations can change on a dime. So something I think that all of us need to just keep in mind. The next chart, can I bring it through, Nick? It's the US dollar. Can I bring it through?
Yeah.
Should we go through some questions now, or do you want to wait till the end?
Well, perhaps we could. Yeah. Do you see something you would like to?
Yeah, there's just a few questions that have come through. This comes from Chris. I'll just read this out. How will they deal with the mortgage bonds? They can let it expire and not suck up the liquidity. The treasury bonds, if they sell it, they will get money. What are they going to do with it? And he makes specific reference to the Fed. I think I'll give you sort of my opinion, and then Nick will jump in if there's anything to add, or if he sort of wants to correct me, because I think this is a good question, and I don't think I have the full answer to it. So typically, Chris, the idea with central banks is they influence, the front side of the curve. So we haven't. Nick and I were discussing about putting in the yield curve. In other words, the tens twos. The shorter part of the yield curve is actually responding in a much more sensitive manner to rate hikes than the 10-year. The 10 years, and we're not talking mortgage, right? Mortgage, we're going sort of 20, 30 years, are much slower. So there's a flattening of the yield curve, and I think that can be a concern. I think the answer to that question, Chris, and of course Nick may jump in here, is of course when the normalization of the balance sheet takes place, well, a lot of those mortgage bonds are going to be traded as well. So the idea here is they're still financial instruments. There's still a secondary market for them, and I think that is effectively the answer. Anything you want to add there, Nick? Chris, let me know if I answered your question.
Yeah, Chris, thank you for your comments, and I don't know if this answers. Obviously, at this point, the Fed has not given much detail as what it's going to do with the balance sheet runoff. What we know from the last meeting minutes is that they are looking, and from various other commentaries, that they're looking to begin reduction, i.e. selling the bonds and getting money back after the first rate hike. Powell was a little bit more vague around it, but again, we expect first rate hike and then the balance sheet runoff. Now, what exactly they're going to do, we don't have details yet, and we're going to have to wait about it. I don't think I can comment more on that, actually.
Chris, did we give you sort of a half answer? Just let us know. The next question is brilliant by Pete, and Pete says, well, guys, even at 3%, that's very good, but if inflation's high, real rates are still going to be negative. I would agree. Yeah. Nick, you want to take that one?
Yeah, I mean, again, I don't know if I can say anything to that. Yeah, he has a point, obviously, right? Peter, thank you. Yeah, but it's not only about rates, though, and there are many who believe that maybe raising interest rates is pointless, and you should focus on the balance sheet, for instance. There are many views out there.
I think just something that's come to mind, Pete, is we've also got to understand that the markets in of themselves are dynamic. Remember Nick's expectations theory emphasis. So the idea here is we're not talking about an isolated monetary policy. We start pumping up interest rates, there is a transition. There's actually a word for it, it's escaping me. It bounces through assets, it bounces through exchange rates, it starts flowing out into the market through a transmission mechanism, and the idea here is it might actually start moderating inflation. In other words, we're not working in isolation. Perhaps the idea here is the interest rates will hike until we get to that what the in economics is called R star. R star means the equilibrium interest rate. There's always a debate what R star is, but the idea is once the hikes come, the expectations are set in motion, and I think that's what the Fed's going to be monitoring. Does that? Sorry, Nick. Go ahead.
Yeah, I totally agree with you, Russell, and that there is also to tie this, and that's why some people are talking about a 50 BPS hike, because they feel like that won't change expectations around inflation. Like, okay, they're little by little hiking rates. Do something massive, break the back of inflation, and take it from there. That's essentially the thing of those who are calling for a bigger hike rate.
Perfect. We're going to just take one question here because I want to move on. It's just Chris is just correcting. He's asking, what's the Fed going to do once they've softened out the liquidity? Well, that's the point. That's the point, Chris. So it's not counted in money supply anymore. Think about it. I guess the way to picture it is it's kind of sitting in a. I mean, it's everything is kind of electronics, cloud-based, etc. But think about it. It's just going to be sitting in a vault, locked away until it needs to go out into the economy again. They've been printing money. They've been using that to purchase the securities. So they're going to normalize the balance sheet by siphoning that money back in. That money is taken out of circulation. It just gets locked away until it's needed again.
They're gonna sit on cash, right?
Yeah, exactly.
It's the role of the Fed to control money supply, essentially. Now there's so much money out there, they need to remove that and normalize, because this is extraordinary policies. The quantitative easing that threw all that money into the market. Now they need to normalize it. And for me, one reason they need to normalize it is because what happens when the next crisis hits with this balance sheet? They're not going to have any tools to fight the next crisis.
Exactly.
And that was the discussion back after the financial crisis, when the Fed started to normalize its balance sheet. Though they're removing liquidity and they're going to hurt the market and growth. But sure enough, the next crisis was right around the corner, right? Imagine now the pandemic having hit, if the Fed had interest rates near zero and their balance was at 9 trillion. What would they do?
Yeah.
That's a question for me.
Great point. Just let us know if that helps, Chris. I'm going to move on. If we need to revisit, we'll do it towards the end. Nick, may I bring up the US dollar chart?
Oh, yeah.
All right. So this is very much, I think, linking back to the expectations theory that Nick mentioned earlier. You can see that the US dollar bottomed. So that's what this red vertical is. This is the bottom of the US dollar, 22nd of Feb 2021. So it's about a year ago. The dollar got absolutely hammered once the quantitative easing started, and it makes sense. We were just the market was getting flooded with dollars. As the as the supply goes up, value comes down. But remember, markets are forward-looking. So the reality on the ground now, that's not what's being priced into markets. Markets are looking forward and pricing and then adjusting as they get new information. And so from the 22nd of February, you can see that the dollar started pricing itself upwards. And the reason it started pricing itself upwards is because market participants as a whole expected the interest rates at some point to move up. They expected that, I think as 2021 evolved, they expected it was very much a more sustained inflation than a transitory inflation. Ultimately, what we have here is a trend. You can see that from the 22nd of February to, I beg your pardon, from the 22nd of February 21 until current, we're moving in that northeasterly direction. Sure, there's volatility. We've got the peaks and troughs, but on an absolute level, we're moving in that northeasterly direction. And I think that says a lot about this inflation story, about this monetary policy story. Any thoughts there, Nick?
Yeah, at around this time of year last year, we started seeing the first fears around inflation. Of course, we don't know if it's going to be transitory, if it's going to go high, but there were the first fears of high inflation started, and that would mean that the Fed at some point would have to act. So these expectations did play into the dollar strength. Of course, there are other factors in play here, right? And it's also against other currencies, the US dollar index. But one of the themes was one of the main themes was that you described.
Yeah, absolutely. And just like the Fed is tightening, we're seeing Bank of England starting to tighten. We're seeing other banks have already moved. Reserve Bank of New Zealand's one of them. There's quite likely we'll see others. The point is we're going to have to measure the movements on a relative basis. My personal feeling, and again, I want to stress, this is not advice, this is just an opinion, is that it's going to be very difficult for other banks to compete against a $9 trillion balance sheet. So I think inherently there is some sort of support for the greenback subject to correction.
Yeah, obviously. I mean, conventional wisdom suggests that this theme is supportive for the dollar monetary policy normalization, and it's far ahead than other banks, not the Bank of England probably, but some other major central banks. Of course, as we move down the road of 2022, as the other banks, since they are far behind, it means that they have more ground to cover, right? So then again, we may see things change. But from what we have seen from the Fed, that for now, we expect that this would, based on conventional wisdom, at least support the US dollar.
I just want to answer a quick question here. Sorry, Nick. It's just from Marie. She's just saying that she would like to get a replay. Yeah, this is being recorded, so you would certainly have access to that. You could just you send an email to sort of your local contact, and they'll get in touch with us. But I would suspect that you'll get an email anyways with the recording link.
Yeah, we will look into that.
Yeah, I just want to move. So we've talked about the US dollar. We've talked about that there is a certain support for the US dollar, and that's going to bring me to the next slide. The next slide to me is a very difficult chart to read. It flummoxes me. I'm going to bring it in nevertheless, and it's gold. Okay, so here is XAUUSD. Now, you can just see the sideways movement in that green rectangle. So from say about March, April 2021 until present, it's just really moving sideways. There might be a slight upward bias to it, but in terms of trend, if I have to go back one chart, you can see absolute trend in terms of US dollar. Okay, just ask you for a trend determination in XAUUSD. I'm going to bet that you're going to have much more trouble in identifying the trend there, as do I. Nick, any thoughts there?
Yeah, this is I don't know what to make of gold. It seems like that there are some competing factors there. I mean, we know that one main driver for the gold is usually risk aversion. Of course, it has to do with the source of risk aversion, but in general, risk aversion tends to benefit. But we have seen some inability recently to take advantage of such things, I believe. And the US dollar is usually acts as a safe haven as well. So these are competing factors, and even inflation can, to perhaps to a smaller extent, be competing because high inflation, as we discussed, supports the dollar essentially. But there's this theory that gold can also act as inflation from a certain point onwards, right?
Yeah, exactly. So gold, I mean, guys that have been attending my webinars know what that I say when I talk about gold. I mean, gold has been a haven, a safe haven for thousands of years. You can go all the way back to, to the pharaohs and their wonderful temples and the beautiful artifacts from their burial tombs. I mean, there's a lot of gold, and the Incas and the stories of the fabled cities of gold. I mean, we don't have to really stretch our imagination to know that gold is a safe haven. And as Nick says, well, wait a second, Russ, the US dollar at the moment is acting as a safe haven as well. So we've kind of got a competition going on here, and that's probably why we're seeing a sideways movement. Is that about right, Nick?
Yeah, exactly.
I think that explanation on this slide is a very good segue into our next slide. And the next slide, I imagine, is going to probably be maybe one of the most controversial. And the reason for that is Bitcoin. Now, the way that Nick and I are looking at this is very much in terms of how we just looked at gold. Well, you've got gold as a safe haven, you've got the US dollar as a safe haven, you've got this kind of competing demand supply between the two sides. Can you apply the same type of thinking to cryptos? Incidentally, there's a comment here from Lisa, and Lisa's just saying the previous discussion would apply to the other precious metals. That's right, Lisa. So she names platinum, and I would suggest that there is merit in that. However, with the cryptos, with Bitcoin, this is a highly divisive instrument. There's a side of the market that loves the cryptos, and there's a side of the market that despises the cryptos, and very little sort of in between. And each side is making an argument for their case. And to be quite honest, I don't believe this debate has been solved yet. And what is this whole debate? Well, the whole debate is that Bitcoin, BTC is a safe haven. Okay, so we go back one slide. Gold, we know, is a safe haven. Lisa, this is not only gold, guys, it's the precious metals. But can we apply that same thinking to Bitcoin? And that's the debate. And the difference in chart here is, I think, remarkable. I just want to go back once more to gold. You can see that gold been drifting sideways. And this is from middle of, let's call it the middle of 2021. Let's just go here. Here is middle 2021, and we actually absolute basis down. If I had to draw a line, we down. Okay, and look, there's no doubt that there has been volatility here. That's not what I'm suggesting. I know Bitcoin is a volatile instrument. The standard deviation here is off the chart, but gold stable, gold safe haven. Go to Bitcoin. Well, churn, but on an absolute basis, it's down. The idea here is that, and Nick can correct me if he feels otherwise, but the debate on the intrinsic value of Bitcoin is still very much up for discussion. That is not the case for gold. Gold, the case has been made. I think we all would agree that gold's a safe haven. Nick, anything you want to say about Bitcoin here?
Yeah, I agree. In broad lines, what you said, there is a debate around as to whether it is a safe haven or not. We have definitely seen some instances where it seems to have acted as such, but it's probably too soon to tell. But for me, it also has wild valuation, as you touched upon. I mean, we can see it going from flying to planting within the same day, and it's also you know, it gets talked up and down a lot. Like we see many high-profile individuals, let's say, that talk it up, then someone else comes and shoots it down. Yeah, I mean, we've seen some, I don't know, what I call the three musketeers of Bitcoin and cryptos. You know, CEOs of Tesla, of Block, former Twitter CEO. And Cathy Wood making various comments around. They're probably one of the most vocal persons out there regarding Bitcoin. So that's one thing that we also need to take into account, that because they tend to affect it.
Yeah, just I think a final word there, and then I'm going to move on just to our other consideration slide. But for markets to be priced accurately, there has to be information flow. There has to be information flow. That's why developed markets are regarded as more efficient than less developed markets, stock exchanges, is because of the flow of information and the almost immediate reaction. And I think what Nick's saying is 100% true. There is an information asymmetry when it comes to Bitcoin. And if there's an information asymmetry when it comes to Bitcoin, then the efficiency of the market must be questioned. I'm just going to go through to our final slide, and then we'll take
because
questions.
We're approaching 1 hour, so let's go ahead and
so this is the other factors. I'm going to let Nick run with this. I'm just going to start with this big underlined sort of bolded growth risk, because I left it out. Nick said no, we must put it in. 2022, I think, has an element of growth risk, and I'm going to turn it over to Nick now.
Yeah, so obviously when we see that central banks are embarking in this monetary tightening process, which is a drag on growth, right? And as we move down this road, concerns may arise around global GDP and growth. Now, it's not a concern at this stage. We don't know if it will become a concern for markets or what the exact impact is going to be, but it may, as we go down this road, become a concern. I just want to point out that we've seen some projections from like the World Bank and the IMF this month. For instance, the World Bank is global GDP decelerating to 4.9% in 2022 from 5.5% in 2021. And the 2022 projection was also downgraded from the bank's previous projections, while the IMF, the International Monetary Fund, also sees similar deceleration, moderation, if you prefer, in global growth. So this may turn out to be a theme for markets. What do you think, Russell?
Yeah, so contractionary policies, in other words, we're lifting the interest rates, they're always going to act as a headwind as opposed to a tailwind. So we've had monetary policy working for growth, to the point now where it's we've got too much inflation. It's getting overheated. That's why we're going into this contractionary. But that's a change in a support that's now turned into sort of a resistance. Yeah. And that's something that we must consider. the COVID situation, Nick?
Yeah, that's the elephant in the room, right? It's what essentially has defined markets since the start, since it broke out. Let's say we've seen the lockdowns and their effects. We've seen the world trying to move away from such restrictive measures, but then we had Omicron, which is much more, from what the science says, spreads faster, but may not be that bad in a way in terms of let's say how heavy the disease is.
Less severe type of more transmissive, less severe.
Yeah, exactly as you said.
Yeah.
But again, it's not something that we can say much about it because we're not scientists, right? But we're gonna have to monitor. It does seem that the world tries to put it in the rear view mirror, but it's not. We're not definitely there yet. But on that thing, what I would be looking, I mean, we talk a lot about how how are things around COVID in the United States or in Europe. But for me, the main point probably is China, because it has this zero COVID policy, which essentially means that one infection can shut down entire factories. So, in light of the Olympics, the Winter Olympics that actually kick off tomorrow, this policy, and given Omicron's high transmissibility, it may be hard to maintain, and in this effort to maintain may prove a drag on economic activity, or they may need to scrap the policy altogether.
Nick, geopolitics. Geopolitics, and I'm going to throw in oil. Just I think they probably can be discussed in the same breath. Anything there?
Yeah, so we've seen obviously geopolitics are with us every year. I mean, from time to time we see some concern around some geopolitical factors, disputes, and everything popping up. Now, this year has started with Eastern Europe tensions around Ukraine. We don't know how this is going to play out, but it is a concern for markets, and it is a concern for markets because it can disrupt oil and natural gas supply. For example, in Europe, we know is very vulnerable to natural gas supplies, and we've seen, for instance, oil hitting new multi-year highs this year, largely driven by this theme. So we've also seen some tensions in the Middle East. So again, that's something that we don't know how it's, let's say, in focus now. It may not be later, but usually throughout the year we tend to see some fears popping up around various areas of the world.
And I think the very sort of last point, and then I'll look at the questions. Trade disputes, you know, before COVID, trade dispute was kind of the big story. You think that it's been very calm along that front? Any risk there?
Yeah, it's not something that it is a big matter now. I mean, we probably have other things to worry, but it's not like those tensions we had seen were resolved. So as we go down, we could see we go down we move forward in the year, we could see issues flaring up there, I believe. And this also sometimes have to do with internal politics, right? Like, let's play tough on trade, so that we will look tough, you know.
Yeah, we're getting very close to our cutoff point here, guys. My apologies. I just want to say, look, everything we've tried to put something together that's very coherent, very logical, very sensible. But just take a look at the last 2 points. Markets are dynamic, emphasis changes, and the idea is, of course, something may happen, and all of a sudden, whatever we've discussed now is no longer the driving theme. So just, I guess, be aware of that. If there's any comments or questions, please go ahead, type those in now. I see Anna's just left, but she did ask what I mean by information asymmetry. She was talking about the Bitcoin market. Well, you know, if there's three individuals that are cornering the market, there's an immediate asymmetry in terms of information. Somebody can buy their Bitcoin today, make a tweet, see the price rise, dump his coins tomorrow. There's an information asymmetry there. I'm not saying that's happening, but if there's such a big information asymmetry, well, that means it's lacking efficiency. Is that something you would agree with, Nick?
Yeah, and it's not only about Bitcoin, of course. We've seen it with many assets, people saying this or that, but even when there are people calling for Fed rate hikes, these people probably have their own reasons why they do it, right? Because they have investors, because they have portfolios. So yeah, that's always a thing, but sometimes the cryptos draw more attention around these themes.
Yeah, and of course, regulation is always a huge risk there. Any other questions, guys? I don't see any other questions. Have I missed any?
Before you wait, I just want to iterate on my part, Russell,
yes, please.
Again, what we say now. For instance, we say that inflation is a very is one of the main drivers of the market, but it may not be like 6 months from now, right? Because it starts to get tamed. So we don't know. Markets tend to focus or to even fixate over different things over different times.
Absolutely. Guys, I don't see any other questions in. I hope that you found the discussion and the format that Nick and I put together. We hope you enjoyed it. We hope that you found it informative. Marie, I'm going to just send you my email. You can send me, because she's just asking for that recording. I'll send it to everyone. You guys can all email me whoever wants the recording, and I'll make sure you get it.
Yeah, so
okay.
Let's thank everybody for joining and for putting their comments and questions in. We appreciate it, and thank you for joining. Hope we find it useful and interesting.
Perfect. Thanks very much, guys, and speak to you all soon. Bye now.
Thank you.